If the bubbling melt-up that is the U.S. equity market is going to be popped, ultimately, it should be popped on fundamentals around the deep disconnect between the financial markets economy and real economy, with risk appetite artificially inflated for so many years in the aftermath of the 2008 crisis. And so we're a little more skeptical about this latest pullback off the record high set over the past 24 hours, with the move triggered by an escalation in geopolitical tension between the U.S. and Iran on the back of the latest U.S. airstrikes. At the same time, there is risk for further escalation, and the event does have the potential to wake investors up to the fact that at some point, bad news may be something they can no longer dismiss, even with central bank balance sheets at their backs. We have seen demand for safe haven assets as a consequence of the latest developments, with the yen, US dollar, gold, and perhaps even Bitcoin benefiting from the tension. There's already been a lot of support for beaten down Bitcoin on dips below 7,000, which could also account for today's price jump, but at the same time, we believe Bitcoin is an emerging asset that should ultimately benefit from risk-off flow, given its decentralized governance and limited supply economics. Of course, overall, we're still in holiday-thin trade, with markets not expected to get back to full form until next week, so all of this price action should be taken with a grain of salt. As far as the Friday calendar goes, key standouts come in the form of German unemployment and inflation reads, UK construction PMIs, and US releases in the form of ISM manufacturing, construction spending, and Fed minutes. As a reminder, at the last meeting, the Fed held rates after 3 consecutive cuts while signaling no hikes in 2020. It'll be interesting to see if the minutes shed any new light on Fed repo market activity, where the central bank has been highly active over the past several months. That's all for now.